Good afternoon, everybody. My name is Tom Malarkey. I'm a partner here in the Insurance and Advisory Division of SW. You're welcome to our session today on the topic of share-based payments. Now, before I start, I would like to acknowledge the traditional owners in Australia. We acknowledge the connections to land, sea, and community, and we pay our respects to their elders, past, present, and emerging. Now, in terms of the order of events for today, I'll set the scene, talk through why this is an important topic, why we selected it for discussion today, then hand over to Jimmy, my colleague, who will give us a high-level overview of share-based payments, talk through some of the definitions and jargon that you'll come across. He'll then hand back to me and I'll talk through some of the accounting concepts and how you apply them. Got some worked examples we can go through as well. I'll then hand to Vikas, who's our valuation expert, who will talk about the fair valuing component of share-based payments. And last but not least, we've got Justin, who will make you aware of all the tax-related issues and considerations you should be aware of before you enter these arrangements. Now, the session will go for 1 hour. We will finish at 2. We have provided for some Q&A at the end of the session. And talking of Q&A, there is a Q&A function at the bottom of your screen. If you just want to click on that, you can type in a question, log that with us, and we will endeavor to answer at the end of the session, or otherwise we'll touch base with you afterwards when the session finishes to help you with your query. Would also suggest you enter the full screen, top right of your laptop or your screen. Gives you the best webinar experience. We are also going to run a poll question today. So that poll question will be popping up on your screen pretty soon. Once you answer that question, the screen will disappear, and I'll make reference to the results of that poll later on in the session. So without further ado, I think we'll get into the session. So in terms of share-based payments, why is this such an important topic to discuss? The standard has been around for a number of years, but it generates quite a bit of queries and requests for clarification from the financial reporting preparer community. So as a result of this, the IFRS, they wanted to know why this is. Is there an issue with the standard that needs to be addressed? So they commissioned some research, and the results of that research was that typically these arrangements, they're quite complex. There's probably 2 driving factors behind that. You're trying to incentivize and retain your staff on the one hand, but you're also trying to manage accounting outcomes on the other. You're trying to avoid uneven expenses affecting your results. So as a result of this, your typical arrangements are quite complex. And if you've got complex arrangements, unfortunately, the accounting will also be complex, and there's no amount of refining or simplifying accounting standards that can negate that. So they're complicated arrangements. There are situations where differences in equity settled transactions and cash settled equity, you price on your grant date, it doesn't change. Whereas for cash settled, you do consider changes to fair value, which ultimately impact the amount that you pay. There are differences in conditions, which lead to different accounting outcomes, difference between vesting, non-vesting, so on and so forth, which we'll get into. But there is some counterintuitive accounting involved. You can cancel an arrangement, but in that scenario, you'll accelerate the vesting period or to the date of cancellation. You can modify an arrangement, and after modification, you might have a reduced value, but you continue to recognize the original value. So there are some accounting issues which create complexity in practice. Because we're in COVID, there has been some modifications which have occurred. So, the whole purpose of these arrangements is to incentivize staff. If the goals, targets are unattainable, it defeats the purpose. So there have been some changes. The modification accounting and requirements are quite complex. And finally, it's always a hot topic for your auditors. They'll always take a look at these arrangements. And from ASIC's perspective, if you're a startup, a new business, and you're issuing prospectuses, ASIC will take a close look at this. So It's an important topic, relevant topic. Hopefully you're all a little bit wiser at the end of the session. And with that, I will hand over to my colleague, Jimmy. I think you're muted, Jimmy.
Okay, unmute myself. Thanks, Tom. Okay, as Tom mentioned, it's a very complicated topic. And before we get into the complexity of share-based payment, let's just go one step back. And I'll give you the basic overview of what is a share-based payment. So we go back to basic. So let's first look at what and why. So what is a share-based payment? It is an agreement between an entity and another parties whereby an entity pays cash, but the amount of cash is determined based on the share price. So that's what we call cash-settled share-based payment. Or the entity can pay their shares or share options to another parties. So when you're giving away this equity instrument, that's become an equity settled share-based payment. So what's the reason we're going through all these complexities? What do we want to achieve? So the reason is, so firstly, is to attract the best talent, especially in this employment market. If you are a startup company, your resources can be very limited, but in order to attract the best talent, having the ability to pay shares instead of cash, it may just give you the advantage that you needed. And also, it's a very effective tool to retain talent. So a lot of the share-based payment does come to have conditions attached to it. So some of the condition can be that employee remain employment with the company for 3 years. So effectively, you are in the next 3 years, the likelihood the person stay with the company does increase. And also it increase the productivities and performance. So what the share-based payment did is it does align the goals. So for example, a chief executive, their goal and the share-based payment, the condition can be for the share price to go up by X percentage. And with that, you pretty much align the goal of the management team and the investors. And that's also applicable to if the conditions attached to some milestones, so they will work harder to achieve those milestones. And last but not least, it is a very effective tool to relieve cash flow pressures. So if you are a startup company, we all know how difficult it is to get cash. And having the flexibility to use your share to pay for certain things, that's relieve that level of cash flow pressure. So that's the reason companies are exploring those share-based payment options. So it is a complex topic, as Tom mentioned, and there's tons of jargons in this whole share-based payment arena. So let's just unpack some of those. So employee share schemes. So as I mentioned before, the share-based payment is happening between the company and another parties. So that other parties can be your employees or it can be a supplier. It is more common when this type of transaction happen among employee. So that's where we have the employee share scheme. So what is an employee share scheme? It's basically a plan or arrangement for the employee to get or to buy the company's shares. So believe it or not, it is not that easy to do that. So one of the very popular or very common share-based payment or employee share scheme is giving away share options. So instead of straight away giving shares, a lot of companies choose to give share options. So a share options is something to give the options to the employee to be able to subscribe to the company's shares in the future at a set price. And the set price is called exercise price. So those jargons are important because it does come to when you are working through the valuations and when you're working through the life cycle of the share-based payment, you will need to understand those meanings. And vest, what does vest mean? It simply means entitle someone with something. So the share-based payment, even I give you the share option, you are not automatically entitled to it. There is condition you have to achieve. So that's called vesting condition, or a period that you have to stay with the company for you to get the shares vested. So vesting conditions, as I mentioned before, can be a whole big variety of conditions. So it can tie to your employment, or you can tie to a certain outcome. For example, if your revenue, the revenue grows by 20%, share price grow by 20%, or you achieve certain milestone, for example, regulatory approval for certain projects. So the last box, we are going to look at some of the date. So grant date, exercise date, expiry date. So those are the things that's very unique to a share-based payment. So in order to explain those dates better, I prepared a case study. So Sarah is joining a startup company as a finance manager. So upon signing the employment contracts, the company does agree to grant Sarah 10,000 options to buy the company's shares at $0.5 per share. And currently, the share price of the company is valued at 1.5%. So it is automatically in the money. So for Sarah to be able to get that shares, she will need to remain employment with the company for 3 years. So the vesting conditions is remain as an employee, and the vesting period is 3 years. So 3 years later, Sarah is still working for the firm, and she's then exercised her options. So she paid $5,000 to get 10,000 shares. And at that point of time, the share price has gone up to $5 per share. So essentially, the market values of those 10,000 shares is 50K. And she has made a gain of 45,000 for her period staying with the companies. So you can see there's a few critical dates that I call out on the right. So we have the agreement date, grant date, and so in this case, the agreement date and grant date are the same date. So it's not necessarily the case in real life situations. And if the share is not exercised, it will get expired after 5 years. So you will have the expiry date. So just a quick recap of this simple case study. So this is an equity settled share-based payment whereby the company give away share options. And the vesting condition and the vesting period is for the person to remain employment for 3 years. So as I mentioned before, the share-based payment or employee share scheme can come in various different types of forms. So I just list down a few common ones to explore a little bit further. So firstly, you do have cash bonus that's depending on the share price. So you see that a lot in a listed company. So the company say you are going to get a bonus if the share price go up by 20% or something to that extent. And the second very popular one is for company to give away free shares or discounted shares. The company and the employee can acquire the company's share at a discount. And also the most common one I'll say is the share plan and share options. So my colleagues later will do a deep dive on these options. And then we also have a little bit funky one that the company give a loan to the employee to acquire the shares of the company. So we call loan funded share scheme. So the accounting of this is a little bit counterintuitive. So you don't really have a loan, you don't really have a loan receivable. In essence, you are treating that as options. And lastly, don't forget, if your group or your parent company have some scheme, it does apply to you. You do need to to understand what are those schemes. And the reason for that is if you are preparing a set of financial statement, you do need to disclose those informations in this year when you are preparing a set of general purpose financial statement. So with that, I'm passing on to Tom to walk you through what are some of the accounting considerations for share-based payment. Tom?
Thank you for that, Jimmy, for that informative section. That was very good. Thank you. So I will take you to the next part of the presentation, the session. I'm going to talk through some typical recognition measurement kind of issues you'll come across, the accounting concepts, and work through some worked examples. Now, before I get into it, would like to talk about the scope of the standard. So as Jimmy has mentioned, there are equity settled transactions. They're settled with issue of your own shares or equity instruments, cash settled type transactions, and they're arrangements which are settled in cash, but there's a link to the share price or movement in the share price in some way. You can have hybrid type arrangements. So these are arrangements which have features of both. You know, you've got the option of equity or cash. And in essence, those type of arrangements, they are split into the separate components and accounted for separately. I have made specific reference here to group share-based plans because there have been attempts by companies, and the standard setters are aware of this, where you can have one entity in a group issuing, share-based type arrangements to employees of another. So it doesn't matter, whether the parent or the subsidiary issues the arrangements, where the employees work, where you've got a group-based scenario, you're going to be captured by the standard. And also just to be aware, if you do issue any of these type of arrangements, get involved with these type of arrangements in exchange for goods or services, you will be captured by the standard. So we've had an example back a couple of years ago, as Jimmy mentioned, these are quite attractive type arrangements to startups. They didn't realize, the consequences of what they were doing. They put an arrangement in place with employees. They assumed if they vest, well, they'll recognize an expense then. We became aware of the arrangement, and they were actually quite surprised when they realized the accounting that transpired for there. They weren't surprised in a good way. So if you are issuing or if you're paying for goods and services with your own shares or equity instruments, you'll be captured by this standard. In terms of some exclusions, I'd like to make reference to if you deal with your shareholders in their capacity as shareholders, you're not captured within this standard. And just be mindful, you may have employees who own shares and you engage or you issue them shares in their capacities as shareholder. It's not captured. The same employees might have share-based arrangements that are captured by the standard. There are certain arrangements, rare, I've never seen them, where you can issue settled transactions and shares of an entity outside of the group. There are certain transactions which are dealt with under SBP-9, which are settled through the delivery of your own equity instruments. They're dealt with through that standard. Probably the other big standard where you'll see equity issues are SBP-3, business combinations. So it's quite popular, quite common for acquirers of businesses to fund the transaction using their own shares, and the specific treatments for how you account for that, and those treatments are in SBP-3. And in terms of the final point, which is also connected to SBP-3, you acquire a business, there's pre-existing share-based plans, there's specific treatment in SBP-3 and how you account for those. If as part of that arrangement, you issue new plans or arrangements to management to retain them for a period of time, that is captured by SBP-2. So there is that distinction that you need to be aware of if you're in an acquisition type scenario. Now, in terms of recognition of, as I've said, if you use these arrangements to pay for goods and services, you'll be captured in the standard. You'll either recognize it in full at grant date, which I'll talk a little bit about, or over a vesting period. You'll either receive goods, recognizing the goods are received, or as services are received. You will typically have an expense. Well, predominantly you will have an expense, but sometimes the expense may qualify for capitalization under another accounting standard. So typically you can see it occur on the SBP 16, which is PPE. You'll also see it, I think, in the mining standard SBP 6, where you in that industry, certain costs and installation costs and the like, the users fund the payment of those services through share-based transactions, and modifications, which I'll come on to later, got very specific type requirements as well. Now this table, it just graphically represents what I've just talked about. So in terms of the timing, when you receive goods, when you obtain those goods, that's when you recognize the share-based payment. When you receive a service, that's when the service is received, is when you recognize the arrangement. In terms of recognition, we've just talked about the debit entry, it'll either be an expense or an asset. And in terms of the credit entry, for equity settled, you'll have an increase in equity. For cash settled, you'll have an increase in a liability. And I'll talk about those two as well a little bit later on. In terms of equity settled, share-based payments are the most common you'll find. I'll go through those in a little bit more detail in terms of measurement, grant date, talk about the different types of vesting conditions, their impact, how they impact subsequent accounting. And as I said, I'll go through some worked examples, which will hopefully explain the concepts which we've talked through. So in terms of measurement, you will measure the transaction in a scenario where you receive goods and services. You should recognize them at the fair value of those goods or services. So if you think external to your organization, you pay a supplier of goods or services, typically that arrangement that will have a market value, it'll be easily obtainable. That's the value you use for measurement purposes. Now, there might be scenarios where you can't reliably estimate, and in those scenarios, you can use the fair value of the equity issued, but typically you would default to the fair value of the goods and services. Now, when it comes to your own employees, you always use the fair value of the equity that you issue, and that's really for practical purposes. It can be quite difficult to measure, the fair value of what the employment or what the service is that's provided. So in that scenario, you will be using the fair value of your equity instrument. So I think that table there just outlines the measurement basis you use. So in terms of the date, grant date, which I'll talk about next, if you issue arrangements to your employee, the grant date's very important. That's the measurement date. As I said, for external non-employee type arrangements, it's the date that you receive the goods and services. Grant date, very important date to get right. If you get this date wrong, your measure wrong, your accounting will wrong, and so yeah, critical to get it right. So that's the date in which your fair value or which your awards are fair valued. It's also the date in which you'll start to recognize an expense. Not always, there can be approval arrangements in place, but typically it's when you start to recognize your expense. It's the date on which both parties have a shared understanding. Now, shared understanding, that's a subjective term, so open to interpretation. So you may need to apply some judgment, at what point and what level of communication is required to demonstrate that your counterparty or your employee had a shared understanding of the arrangements. And in terms of, typically once you have that shared understanding, you can evidence that that's when you value your arrangements. There can be scenarios where there is shareholder approval required. Typically, if you issue to directors or key management personnel, it'll need to be approved at the AGM. And I have had an example in practice a couple of years ago where, arrangements were entered into, and the understanding was, they'd be valued at the share price at that point in time. There were directors did have to go through an approval process. 6 months later, share price had moved significantly, so there was a much greater expense than was originally anticipated. So very important to understand, the requirements for grant date, what it is, when it requires, because it does have pretty significant fundamental impact on how you account for these arrangements. Conditions. So again, typically you'll issue these arrangements and it will be subject to satisfying certain conditions. You've got three main types, as I'll go into in a bit more detail. You've got service conditions, and that's really around, well, you have to be retained within the employ of the issuer for a period of time, typically 2, 3, 4 years. And then you can have performance conditions. Now, these conditions can be either market-based or non-market-based, and it's very important to get these conditions right. There is quite distinct accounting requirements depending on what kind of condition it is. So in terms of service conditions, as I mentioned, there's a period of service required. You'll value at the grant date and it's amortized over the vesting period, typically on a straight line basis, although there might be scenarios where a more appropriate basis is used, but it'll typically be straight line. And there can be scenarios, or you can, I beg your pardon, you can adjust the amount of the expense that you recognize based on what you think will ultimately vest. So there's a percentage judgment component which you'll adjust for at each reporting date, which is important to understand. In terms of market-based performance conditions, they're typically arrangements which, you know, there's a link to the market price of your shares. There's a market capitalization requirement that needs to be achieved, or there's some kind of a condition which is linked back to share price. You'll value those arrangements at grant date, and there's no subsequent change for whether those market conditions are achieved or not. You don't, after grant date, you don't recognize or change the expense that you recognize. It is set at that point. In terms of non-market based conditions, these are typically conditions, you know, internal to the organization. You know, it can be certain revenue levels, profit levels. You can put in place, you know, achievement of certain milestones you become entitled. So, for instance, if you're working on a vaccine for COVID, there's certain milestones in the process before that gets to market. You can incentivize people as they reach those milestones, they become entitled to these arrangements. You know, feasibility studies, for instance, you know, you've gone through a process, you've demonstrated something is achievable, and now you can get that funded. That could be another milestone that you can use. Now, in terms of non-market, again, at grant date, they're valued and recognized, but again, for non-market, you can adjust the expense as you go, as you become more aware of how less or more likely that the arrangement is going to be achieved. In terms of this table, it just outlines what we've just discussed there. So market conditions are taken into account at fair value date. You'll recognize the expense irrespective of whether that condition is met or not, which is different to market or service conditions. So if you can reverse depending on whether the condition is met or not. There's no change in the number of instruments in the market condition scenario, whereas again, you can revise at each reporting date. Fair value for your market conditions is not adjusted during the life of the arrangement. Now, I've got a couple of examples which we can work through. Now, I'm conscious there's a bit of detail on the slides. These are taken from the back of WSB2. There's illustrative guidance. These are, believe it or not, these are actually probably the more simple solutions or the simple examples that are used in the standard. But this first example, this is, you know, a pretty straightforward arrangement. You know, you're entitled to options subject to completing a service, a particular service period. So the options are valued at $15, and the entity estimates that about 80% of their employees will meet this condition. So over the, you know, day one, you expect, you know, a pretty even contribution or an even expense throughout the life of this arrangement. Now, as you go through the number of years, at each date, the employer, they can adjust the number of employees they expect to become entitled. And as they do so, you'll pick up a cumulative, almost like a true up or a decrement, depending on what you estimate will ultimately vest. And then at the end of year 3, you'll know exactly how much will vest, and you recognize the actual expense based on the share option price, which doesn't change, but the number that does vest will equate to the number of employees that do that meet the condition. Another simple example here. Now we're talking about a key management personnel in this scenario, a senior executive. Again, they're issued options and they're expected to meet the service condition. Now in this scenario, irrespective of whether this condition is met, the market condition, so I think this is a share option arrangement, share price needs to hit a certain level before they're exercised. Irrespective of whether that condition is met or not, you will recognize $80,000 in your P&L over the life of this arrangement. Now, on the other hand, the service condition component, if during the course of this arrangement, year 1 and 2, we expect the executive to remain. If in year 3 the executive leaves for whatever reason, then you will reverse that expense, and you reverse it in year 3. You don't do any kind of prior period type changes. That will adjust. So in the service condition, you can reverse previous recognized expenses. For a market condition, you do not change the amount that vests, irrespective of whether the condition is met or not. So that, in simple terms, is kind of the distinction and a manner in which the conditions can significantly impact the accounting, quite significantly. In terms of cash settled, as we've touched on previously in the session, I think the main difference here to be mindful of is that the liability you do factor in changes in the fair value of the arrangement over the course of the arrangement, and those changes will go through the P&L. So for a cash transaction or cash settled transaction, you will adjust to the cash amounts which ultimately vest. And that's important to understand. It's probably why you don't see as many cash settled arrangements, because there does have this cash component which can vary. Whereas with equity settled, you do tend to have obviously they're not cash settled, but you can have, or you're more likely to have, a more even expense. I've got an example here. Apologies, I know it's a very involved example. It's taken from SBP-2, but if you, in your own time, if you want to work through this example, we will provide the slides at the end of the session. It'll demonstrate how the fair value is used to adjust as you go. So in this example, you adjust fair value at each reporting date. Remember, under equity settled, you didn't. And then you adjust as you do for other service or non-market conditions for the number of people who you think are going to become entitled. Now, final slide for me, I'm just going to touch on modifications. Can get quite complicated quite quickly once you delve into the modification scenario. So there's just a couple of key points. If you remember these, I think you won't go too far wrong. You'll always, once you recognize a share-based payment, the minimum expense you're going to recognize is the amount of that original transaction. So you might subsequently change it, and the fair value might increase. And if the fair value increases, you will recommend, or you will recognize an uplift from modification date to vesting date. If the fair value increases, you don't adjust or you don't change your accounting. You continue to recognize the original calculation. In terms of cancellation, if you cancel an arrangement, it doesn't mean it's like it never happened. You accelerate that vesting period and you recognize the remaining amounts due to cancellation date. And forfeitures or cancellation, sometimes it can be quite difficult to discern the distinction between the two. As I mentioned, cancellations, you accelerate unvested previous or unvested amounts, you accelerate those. Forfeiture, you end up in a scenario where you can reverse. So my advice when it comes to modifications, talk to your accountant, make sure you understand what it is you do, what you want to do, and what the accounting consequences are. And indeed, before you enter into any share-based payment, you should do that. So that's it from me. So at this point, I will hand over to Vikas, and he'll talk through the valuation consequences we need to be aware of.
Thank you, Tom. That was quite intriguing. I've always found share-based payment arrangements to be very interesting, but I've learned something new every time I've looked at them. I guess partly because most organizations have different objectives out of their plans, and that's why the plans are so different all the time. In terms of what I'm going to cover, I'm going to cover some common instruments and pricing models, and then just jump right into some common issues, not getting into too much detail because that could take years to really go through. I've listed some common instruments here that I guess Jimmy and Tom have touched upon in their sections. I'd probably just note that most of the share-based payment arrangements, whether it's rights, loan-backed shares, share appreciation rights, they've sort of got similar structure to a call option, where the holder's got the right but not the obligation to buy the underlying securities at a pre-agreed strike price. I'd also call out the difference between American, European, and Bermudan options. The American options are ones that you could exercise anytime up until expiry date. The European ones can only be exercised at expiry, and Bermudan ones, I must say they're not very common, but they can be exercised at certain predefined time intervals. And these are sort of defined within the term structure of the instrument itself. Moving on to the pricing models, I guess Black-Scholes, binomial, and Monte Carlo are the three sort of commonly applied valuation methodologies to value share-based payment arrangements. Black-Scholes, also known as Black-Scholes-Merton. I'm not sure why we leave Merton out of the slide deck, but his contribution to the option theory was quite significant as well. Anyways, the model uses different, or rather differential equation to price vanilla European options. Reminder, European options are the ones that you can sort of only exercise at expiry. The binomial model, that is sort of an iterative model. You've got an example of the binomial tree there. It's a pretty simple one. The actuals that you'd see are typically at least 40 steps and goes up to 200 and more if needed. But in theory, it is effectively valuing at each iteration an uptick and a downtick. You value at the last node or the last nodes and then move backwards. And the value at the first node then gives you sort of the value of the option. Just sort of as a sort of note here, each of these models can actually value both call and put options. So it's sort of important how you set them up and you pick the right sort of value. More often than not, it's the call option that we're looking at. Again, I can sort of go into the detail, but it seems like I'll probably need at least a few hours to go through the binomial model in its own right. The Monte Carlo model, that's sort of relatively more flexible than each of the other two that sort of we've got there on screen, and typically used when you can't necessarily apply a Monte Carlo, a Black-Scholes or binomial model to the instrument. More often than not, it would be for arrangements where you've got market-based vesting conditions, which are hard to sort of model in Black-Scholes. You could model certain conditions within the binomial construct. But I think it's just sort of easier to build a bespoke Monte Carlo sort of model to capture some of those nuances. Regardless of the model that you're using, the inputs are pretty similar across all of these models, which include, as sort of Jimmy touched upon earlier, the spot price, time until expiry, the volatility of the underlying share price, risk-free rate, exercise price, and dividend yield. The arrows out there on the screen indicate how sort of the value of the options relate to each of those inputs in most cases. I mean, there's sort of certain exemptions, but you'd probably see them mostly when you're sort of modeling market-based vesting conditions, and some of those relationships would then break. Just as an example, you'd sort of see the value of the option going up if the spot price goes up. Same way, if the exercise price is higher, then the value of the option would be lower. Jumping into some common issues, I've got a big list there, but I'm not going to touch upon each of them. Leave them there for you guys to digest. Happy to chat on any specific issues that you might be dealing with. We can take that offline, but the most common one that I'd probably note where the clients have come in and said, hey, look, there's no suitable option pricing model that I can apply to this particular arrangement. What they're really saying is there's no simple calculator that exists. You can't necessarily apply a binomial or Black-Scholes sort of calculator that can help you calculate value, which in this instance, again, you can sort of model a bespoke sort of Monte Carlo model that would then be able to capture those sort of unique terms into the valuation construct. Now, that's one of the main issues, again, where some of the primary or initial calculations that I see from clients, they completely ignore market-based conditions. And that's the main reason for that as well, because you haven't even thought about Monte Carlo at this stage. The other one I'd probably call out is with the spot price or the share price at the time of grant or the valuation date. A lot of us take that as a given. And especially so if it's a listed company, but I think it's sort of important to just sort of test that hypothesis as you start working on an option pricing model, whether the share price is reflective of fair value or not. The sort of number of instances where it may not sort of be the right number to use, especially if it's a thinly traded sort of listed company where share price is not reflective of fair value. The other piece could be that there's sort of some post-vesting restrictions in terms of when you can sell these shares. Again, in that instance, there might be a need to sort of discount that spot price by a certain amount to reflect that post-vesting sort of restriction, or rather post-exercise restriction on the shares that you're going to get on exercise of these options. The other one that I'd probably call here is accounting valuations versus tax valuations. Now, these things would typically be very different, and a number of times your AASB2 valuation may not speak to your tax valuation, which sort of ignores or does take into account some of the conditions that sort of AASB2 would preclude you to. Obviously, I love my valuations, but I'm not a tax or accounting expert, so I'll leave, I guess, my accounting and tax colleagues to battle on what's more reasonable. You've obviously heard from Jimmy and Tom on what the accounting issues typically look like. On that note, I'd like to pass it on to Justin so he can sort of talk through some of the tax considerations on employee share schemes. Over to you, Justin.
Thanks, Vikas, and good afternoon, everyone. The last section that I'm going to run us through are just some of the tax considerations that it's important that organisations think about when implementing and administering an employee share scheme. So on this screen, I think Jimmy mentioned earlier, and some of the types of plans that organisations look to implement, whether it be share plans, options or rights plans. We've got plans that qualify for startup concessions. We've got a $1,000 plan, loan funded plans, as well as employee share trusts, which a number of organisations use to help administer plans. What I thought it would be really useful, just to take us through a really quick high level overview of some of the tax implications of some of the more common plans that we see. So for a share plan, there really are two types of tax implications that can apply to the plan, and it really is dependent on how the plan is structured. But the default position is that the shares that are issued or granted to employees will be taxed on date of grant, and the employee would be taxed on their income account, so assessed at their marginal tax rate. And then any future appreciation in value of those shares would be assessed on their capital account, which then would also provide them with the 50% capital gains tax concession, assuming that they're a tax resident. The alternative tax implications would be where the plan is structured to qualify for tax deferral. And where the plan does qualify for tax deferral, the tax would be deferred to the earliest of one of these particular events, which is outlined in the table. So that is when there is no further real risk of forfeiting of the shares, or when the employee ceases employment. Now, this particular rule will be removed shortly, provided that the deferred taxing point occurs on or after 1 July 2022, or at the 15-year mark from when the shares were initially granted. And again, once those shares are assessed at the deferred taxing point on the individual's income account, any further appreciation would be taxed on the individual's capital account. For a rights or an option plan, again, very similar. The default position is that they are assessed on day one. So it's then important to determine what's the value of the right or the option. And the ATO do have tax regulation tables that will help determine what's the intrinsic value of the right or the option on date of grant. Where the plan does qualify for tax deferral, then the taxing point for the employee will be pushed out to one of those earliest taxing events, which is very similar to the shares that were mentioned earlier. But again, it's the earliest of when there is no further real risk of forfeiting the options and no restrictions on the sale of the options or the underlying shares. Termination of employment, which, as I mentioned, will be removed from 1 July 2022 for any deferred taxing points beyond this date, or 15 years from when the options were granted or the rights were granted. The startup concessions were concessions that were introduced by the Australian government in July 2015. Now, these startup concessions from a tax perspective are very attractive for both the participants in the plan, but as well as the organisation utilising these concessions. So when determining whether an organisation qualifies to use the employee share scheme startup concessions, there's two things that need to be looked at. One is firstly, is the company considered a startup company? And I've outlined on this slide some of the conditions that need to be satisfied. So firstly, the company must be all companies within the group need to have been incorporated for less than 10 years in the year of grant. And the aggregated turnover of the company must not exceed 50 million in the financial year before grant. So once we've determined whether the company qualifies as a startup company, the second thing that needs to look at is the plan that is being designed and implemented. Does that plan qualify under the startup rules? So if an organisation is looking to implement a share plan, then the key criteria is that the discount that's being offered to employees cannot be greater than value on date of grant. Immediately after grant, the employee must satisfy the 10% ownership and voting rights test, so they can't hold a beneficial interest of more than 10% of shares. And there needs to be a minimum holding period of 3 years. For an option plan to satisfy the startup concessions, the exercise price, and Jimmy touched on the term exercise price earlier, but the exercise price at date of grant must be at least equal to fair market value of the underlying share on date of grant. So effectively, the options cannot. The second condition is that the employee participants must also satisfy the 10% ownership and voting rights test. And again, the options must be held for at least 3 years. So where the plan is structured to meet those conditions, then the plan would qualify for the startup concessions. And those tax startup concessions effectively result in no income tax to the employee on date of grant, nor on date of vest, nor on date of exercise. Effectively, it pushes out the taxing point to when the individual sells the underlying shares. The other key benefit is that it moves the taxing of the increase in value under the capital account. So rather than being assessed on income and assessed at the individual's marginal tax rate, the individual would assess it as a capital gain. And assuming that they've held the option and or share for at least 12 months, they'd be entitled to the 50% CGT discount. So it effectively halves the tax rate. The benefit for the organisation is for a private company trying to determine, well, what's the value of the underlying share? The ATO have introduced an ATO instrument that approves a safe harbour method to value the underlying shares, which effectively looks at the net tangible asset value position of the company. We touched on employee share trusts. These are common structures that organisations use to administer employee share plans. There are some benefits. Just with the interest of time, I'm not going to go into too much detail. There are some information on the slides, but some of the advantages of using an employee share trust, there is an ability to reuse forfeited shares. So if someone leaves the organisation through the vesting period, those shares can be reallocated to another participant. And the organisation can look to warehouse shares within that trust for future use. It also entitles it can also entitle the organisation to a corporate tax deduction. So ordinarily, when an organisation is offering shares or options to employees, there is no corporate tax deduction other than the statutory deduction for the $1,000 plan. Some of the disadvantages or issues to work through, it is a lot more of a complex structure. The employee share trust does need to satisfy the sole activity test, which when an organisation is thinking of an employee share trust, we do typically recommend to obtain a private binding ruling from the ATO to ensure that they sign off on the structure to ensure that there's no surprises down the track. Some additional considerations when working through implementing a plan. It's also always important to work through some bad leaver and good leaver scenarios, ensuring that that's very clearly documented in the plan rules so all participants understand what happens under certain scenarios. One issue that we see a number of companies unfortunately miss is understanding what your employer reporting obligations are to the ATO. So it is important that employee share scheme statements are issued to employees in a year that there's a taxing event by the 14th of July. There are reporting obligations to the ATO by the 14th of August following year end. Here at SW, we do have ATO approved software, so we can assist organisations if they are looking for assistance in meeting those reporting obligations. And then my last two slides are really just two recent tax changes to the employee share scheme rules. One I did touch on one of the earlier slides, which was the removal of the termination of employment as a deferred taxing point, and that will be removed for any deferred taxing points that occur on or after 1 July 2022. So any organisations that do have an existing plan, we do recommend that you review those plans and any communications that are being sent out to staff around updating those to account for the changes in tax law. The other recent change was a draft tax determination issued by the ATO around the deductibility of establishment costs of an employee share scheme. So the Commissioner has stated that the costs in establishing or amending an employee share scheme are not deductible under Section 8.1 of the 97 Act. However, they can be deductible over a 5-year period under Section 40-880, which is also commonly known as the black hole expenditure. So I'm going to pass back to Tom now to see whether we've got any questions that we can run through.
Thanks, Justin, for that. We don't have too many questions, as it so happens, and I thought that might be the case given the nature of today's topic. But there are a few I'd like to ask. So I think the first one, Jimmy, you might be able to answer this one for us. So we are an Australian subsidiary. How do we know if the group has an option plan or share scheme that might potentially affect us?
Yeah, that's a very good question. We have a few clients like through our audit, through our questioning, then suddenly realize they have a share-based payment at the group level. So a few red flag, so to speak, to look after is sometimes the group will give you a bill. So basically say, hey, this is the amount that has been paid to your employee, so you need to foot the bill. A lot of time you're looking for the wording like performance plan or certain scheme or certain plan. If you have those words along the line, so probably you want to raise the alarm bell to see is that such things. You can ask the group HR for that questions, or simply look at the group financial statement. So if your group is a listed company, all the financial statement will be publicly available, and just search for those keywords. Then it will give you a very good indication whether or not the group will have certain plan. And if so, you will probably want to ask a bit more detailed questions like, okay, who is then on the plan? And do be careful, those are very P&C information, so handle this with care.
Sure, thanks for that, Jimmy. I've got one, I think this is for you, Vickers. The difference between an impact of contractual life versus options life. So I believe that's a valuation question, Vickers.
Yeah, thanks, Tom. Yeah, I think it's a good one, and I've sort of had a couple of instances where it had a really sort of big impact on how we sort of approach the value. If you think about the option, it's got sort of two parts to value. One sort of intrinsic value which is the difference between the spot price and the exercise price. The other part to value is the time value, which means the more sort of time you have to exercise the option, the higher the value. Now, a lot of, for example, taking an example of a loan-backed arrangement, for example, most of these contracts would typically have like 10-year repayment term on the loan. And if you step back and say, hey, would that employee actually stay with the firm for 10 years? Probably not. So it's always good to sort of estimate when this arrangement is going to sort of be exercised, which might mean that you move back to either the time when the employee is expected to exercise or when the employee is expected to leave, and that becomes your sort of life that you put in the option pricing model, and it could have a significant impact on value.
All right, thank you for that, Vickers. Now I think we're coming up towards the close of the session. I'll just, in terms of poll results, I'll just give you the results. About 40% of respondents thought measurement was their biggest challenge when applying this standard, not surprisingly. Luckily, we've got an expert here, Vickers, who does these all the time. So if you have any problems, he's the man to talk to. 30% talked about vesting conditions. So those are the main two challenges that our participants are facing. My advice, always talk to your accountants, as I said before. We're happy to help out if you so need. So with that, I think we're going to wrap things up. Just a reminder that we will be running a financial services webinar in the next couple of weeks, and that'll be hosted by Renee Muller. She's going to be, she's the leader in our technical advisory division. She'll be leading that one. So if you're in the financial services sector, please tune in for that. Thank you for attending today's session.